Good afternoon and welcome to the Plant Healthcare PLC 2022 half-year trading statement investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Chris Richards, Chairman, Jeffrey Hovey, CFO, and Jeffrey Tweedy, CEO. Good afternoon.
Thank you, Paul. Good afternoon, and good afternoon to everybody, and thank you very much for joining this webinar. We're delighted to be presenting our very positive first half 2022 results. And I personally am particularly pleased that we announced on that as of June the 22nd, Jeff Tweedy took over from me as CEO, and I went back to the chairman role. So amongst other things, that means that Jeff, who's the architect of this great performance, will be presenting these slides. So, and I shall come back and help with the Q&A. So on that note, I'm going to pass over to Raleigh, North Carolina, and to Jeff Tweedy.
Thanks, Chris, and good afternoon. As Chris said, what a great first half we had. Just an executive summary here and remind investors, we have a proprietary line of products which really help increase yield and stress on plants, and we work with growers around growing more sustainable type crops. Now, to get into the numbers a bit, really strong first half. Our revenue was 5.6 million, up 60%. Gross margin increased to 61% from 56% half one of 2021. And what's really driving a lot of this is not only our new products, but expanding our markets. We added new markets in Brazil, or a new 5-year agreement, which we'll talk about in a minute. We also expanded our Harpin business into Argentina and Uruguay, which we will harvest those results in the coming years. We also increased revenue from our Harpin business. We grew Harpin Alpha Beta 37% to 3.3 million in the first half, which was a great accomplishment, and we'll talk more detail about where that came from. And then the launch of Sori. Sori is our new pre-tech technology in Brazil. We have a new 5-year agreement with Nutrien, and we had revenues of 800,000 in the first half, which was great to really get this product launched and going in the Brazil soybean market. Now, what is pre-tech? Pre-tech is vaccine for plants. We call it vaccines for plants. This is a new technology. We launched Sori in 2021. And we plan to have annual launches over the next coming year, every year. And we should be receiving registration, our first registration in the US, sometime later this year. Our products really deliver increased yield and return on investment for a grower. We have increased yield of over 23%, which means greater than 14x for a grower. And I think what really separates us from other companies in this space are these global distributor partners: Nutrien, Wilbur Ellis, Ager, who's a new one, Agri out of the UK, and Coplacana. We have unique relationship with them, exclusive agreements with them. I think that's what's really driving the growth and their interest in these products. They're behind it. They put a lot of resources behind it, and we feel like these type of relationships will continue to add to. And we're on track to deliver the 30 million by 2025. So just a little bit about our business before we get into the numbers. As I mentioned, we have proprietary biological products, which really help increase the plant health yield. And there's two pieces to that business. Harpin Alpha Beta, which is a protein technology, very environmentally friendly, makes plants healthier, resists disease, stress, and really help with quality. We see much better quality in some of the specialty crops like citrus, for example, which helps with longer shelf life and also increased yields. In sugarcane, we really see this return on investment for a grower, 14x in sugarcane. And then the U.S. corn, it's really around yield. I can tell you the crop is under high stress this year, so we expect to see similar type of yields from use in corn this coming season. Now, the new technology is the pre-tech. Very excited about this. Vaccines for plants, we call it. We really feel like this is a disruptive peptide platform. It's proprietary. We've invested over $25 million in this technology. We've been able to achieve fast-track regulatory status in Brazil. Our registration came within 1 year, which is quite significant. It can take 2 to 3 years to register new products in Brazil. As I mentioned, our first launch was in 2021 with Sori, and we have a planned launch in the U.S. later this year with Wilbur Ellis, pending the registration approval from EPA. And then we want to launch one new product each year over the coming years. So this is kind of an overview of our platform. We have the existing business with the new technology coming in, and very excited not only about the performance, but also the performance from a financial perspective. And Jeff Hovey's going to get into some of those numbers.
Thanks, Jeff. We had a really great first half of the year. I'm very excited, and I want to thank and congratulate all of the Plant Healthcare team globally. So for this slide, I'll talk a little bit about the highlights and get into details in the next 2 slides. As Jeff said, our revenue was $5.6 million, which was a 60% increase over half year of 21, or 62% in constant currency. Our gross margin increased 5%. Our cash operating cash burn increased 40% to $2.1 million. I'll talk a little bit more about that in the next couple of slides. Cash at the end of June was $6.3 million. Commercial business achieved an EBITDA of around $600,000 and generated approximately $300,000 of cash. As Jeff said, our Harpen business was up 37% to $3.3 million, and the gross margin stayed steady at 67%. We continue to have market access with 4 of the top global distributors. And as Jeff said, we had a successful soy launch in Brazil. We've secured low-cost production, and we plan U.S. launches in 22 and 23. Revenue of $5.6 million reflected growth in all regions, with the exception of the EMEA region, which was held back due to drought conditions and, to a lesser extent, the decline of the euro versus the dollar. Sales in the North American market increased 133%, mainly due to increased sales into the specialty crop market. Sales into the sugarcane market grew 72% versus first half of 21 due to strong demand with sugarcane processors. And finally, we experienced the successful full launch of Sayori in Brazil, which generated $800,000 of sales. Harpen revenue increased 37%, similar to the total revenue. All regions were up, with the exception of EMEA. The Americas, as we define as North America and Brazil, led the way and was up 125%. Gross margin increased 5%. This increase was driven by increased Harpen sales into the Americas, combined with the launch of Sayori in Brazil, which has a higher margin on average than Harpen Alpha Beta. Cash operating expenses increased 22% to $5.2 million. The increase is due to the planned investment in pre-tech product launches and the continued expansion of the commercial business. The first half 2022 expenses were held at the same level as the second half of 21, which reflected the increased spend following the March 21 fundraise. The adjusted EBITDA decreased $500,000 or 22% to $1.8 million, as we saw increased gross margin offset by the increase in operating expenses. Our operating loss was significantly higher at $6.2 million than the same time last year. This is primarily due to translational losses that we experienced in the first half of 22. Just a reminder that translational gains or losses are non-cash, and they're driven by movements in the pound associated with our intercompany sterling loans. Finally, looking at the chart at the bottom right, this graph represents the first half sales between 2019 and 2022, which shows the 35% CAGR. The growth is due to double-digit growth in all regions, with once again Brazil and North America leading the way. Turning to the balance sheets, as we've mentioned in previous presentations, working capital is a high priority for the company, and the company is still committed to continuing to keep very tight control of working capital. Inventory increased 1.3 million to 3.4 million versus the end of 21. The increase was mainly due to Harpen purchases to meet the projected strong demand in 2022, as well as make sure that we have adequate supply. Considering the supply chain issues that's happened over the past and still happens to a certain extent, the company is confident that with the inventory purchases that we made in the first half, as well as our relationships with tool manufacturers, we've mitigated any supply issues for the foreseeable future. The receivables decreased 400,000 to 3.2 million due to the seasonality of our revenue, which is typically weighted towards the second half of the year. Typically the first quarter of the following year shows high collections. Over the past few years, our revenue has been weighted approximately 40% to the first half, with the remainder in the second half. This year, we expect a little bit more of an even spread, still weighted towards the second half, but not to the extent that it's been in the past. We continue to have strong working relationships with all of our distributors, and we remain committed to keeping our DSOs as low as possible. The payables and accrued expenses increased 400,000 to 3 million, mainly due to one-time payments to a few of our suppliers. As I mentioned, working capital increased slightly to 4.1 million, driven by the increased inventory and payable positions, offset by lower receivables. Cash used in operations increased 600,000 to 2.1 million due to a few factors. The first being the increase in the operating expenses associated with pre-tech launch, as well as growing the commercial business. Once again, this spend is keeping with March 21 fundraise. The second factor is due to the Harpen inventory that we purchased in the first half. As a reminder from last year's presentation, we did not purchase any Harpen in the first half of 21. So that's a big difference. And the third factor is the increase in collections that we experienced due to strong fourth quarter sales in 21, as well as the revenue growth in 22. The borrowings number is, I think I've mentioned this in the past, due to IFRS 16 requiring us to put leases on the balance sheet. Excluding IFRS 16, our debt is around 100,000. And finally, as I said, the cash and cash equivalents was 6.3 million, and we remained confident of reaching cash positive within our cash reserves.
Okay. Thank you, Jeff. So let's get into the commercial piece just a little more in detail. As I mentioned earlier, we have very strong global distributor partners, and these are important to help us drive the market access and the revenue goals that we have set. So if you look at, okay, where did the growth come from? About just over 800,000 came out of the U.S. Harpen. This year, in the first half, we had an increase of 200,000 in our Harpen sales in Brazil and sugarcane. The soy launch, which we just mentioned, around 800,000, and our Mexico business, we call it third party, but Mexico had a good increase, not only return of crops that we apply our products on, but also market expansion into avocados and agave. As Jeff mentioned, our EMEA business was down slightly. This is due to the severe drought that's going on in the EMEA region and some on currency. So year over year, we grew the business over 60%. And again, it's really due to the relationships that we have with these strong partners. We plan to continue to grow the business with them and expand these distributors in other markets that we're not in today. So what are the drivers for Harpen and soy growth in 22? We've got strong demand in crop prices. We've seen some increase, although the last few weeks it's been down, really driven by the Ukraine invasion. and higher prices. Fertilizer prices have definitely been an issue in supply, and we've seen some benefit to that, and where growers are looking to increase yield, and these type of products really helping drive yield. When you have high commodity prices and limitations on fertilizer, they're looking for alternatives, and we've been a very good partner and supplier for that market, and we have ample supply. So if we look at where the business is growing this year, in the first half, it's really come in our grape, citrus, apple, and pear market. We have significant potential in California. I feel very confident about that going into the fall of this year and into 2023. And we have planned our first launch of a pre-tech in the U.S. Pending regulatory approval. And we really feel that this will be incremental to our Harpin Alpha Beta business in the specialty crop market. In Brazil, our first half on-ground sales in sugarcane were up 65%, really due to strong demand from sugarcane processors. We expect that to continue in the second half. And our new agreement with Nutrien, as I mentioned earlier, we're targeting on-ground sales of 150,000 hectares of soybeans this year, which would be a significant amount. It would be over 20% of their treated seed year one, which would be tremendous success. And revenue from soy really projected to grow more than 5 million by 2025. And I think that's going to be really important for us as we start to reach the 30 million target. Growth with soy will be a key driver to that. So we feel we're strongly positioned going into the second half of the year, and we expect to have a strong finish to the year. Just a bit on next slide. Just a bit on the sugarcane. As I mentioned, we've had strong on-ground sales this year. If you look at the chart on the right, 65% growth in the first half versus previous year. And this has really been attributed to strong demand from processors, but also there was a significant drought last year. So our midterm forecast on this is we'd like to see sales somewhere around 15 million. And we feel very good about the prospects of growth of Harpin Alpha Beta in the sugarcane market. The next one is a new opportunity, which I just want to touch on as we expand our distribution. Next slide. Sorry. As we expand our distribution into other countries, Argentina will be the next one. They're the world's third largest producer of soybeans. We have a partner in Ager who has access to around 3 million hectares of soybeans. And our first sales will happen this fall with plans to expand in wheat as they add wheat to the registration. And we're looking to work with them to expand into Uruguay. They have quite a bit of they have a significant presence there. And we sell it under the brand name ProAct. It's a seed treatment, protects against disease. Yield is really what the grower is, the benefit that a grower is seeing from it, up to 5%. And it can be a significant drought in some of these areas. And that's where we really see the benefit of Harpin Alpha Beta protecting that soybean plant from the drought and diseases. And we're targeting over 1 million in sales with this customer by 2027. Now, if we turn to pre-tech, as I mentioned earlier, we have a new 5-year agreement with Nutrien. The Brazil market is projected to be 42 million hectares of soybeans. That's up substantially from 2021. This is the largest producer of soybeans, and it's a significant market for fungicides. 2.5 billion is spent in fungicides, and that's where soy really provides protection of the soybean plant from not only Asian rust, but we just added several new diseases, early season diseases to the label this year. We're working with Nutrien. They're the largest distributor in the world. They've made a major investment in Brazil. We have a new 5-year agreement with a minimum target of over 1 million hectares with them. And we've had excellent results from our 200 plus demonstration trials with growers. We saw about an average of 7% yield increase which is worth more than $150 per hectare to a grower. So very significant return on investment. As I mentioned earlier, first half sales were $800,000 in this first year, and we expect significant growth over the coming years with a target of over $5 million in sales ex PHC. So that's kind of where we've been. Where are we going? And so we've got the first launch of pre-tech in the U.S. is projected for third, fourth quarter this year, depending on regulatory approval, and that will be with Wilbur Ellis into the specialty crop markets. We submitted earlier this year a registration for PHC 949. This is our new nematicide in the U.S., and I'm very excited about that. We've had excellent results, nematode control in specialty crops and row crops, and I think that's going to be a significant revenue generator for the company. I'm more excited from a technical standpoint about that product, what we've got coming in the product line. Beyond that, we want to expand in Brazil into new crops, looking at targeting disease control in new crops, coffee, sugarcane as an example. We want to register PHC 949, so we'll be submitting that in Brazil in the third quarter of this year, with an expected registration in third quarter of 2023. So we're anticipating that we'll have a very quick registration as we did with the Sawari. Beyond that, we're looking at pre-tech in combination with foliar fertilizer in potatoes for the UK. We're working with Agri in the UK, and they've had some very positive results last year. Indications are it's looking very good this year. If that goes well, then we could be launching in 2023 that product. So when Jeff mentioned earlier about the investment that we've made through the fundraise a year and a half ago, this is where we want to take it. So we delivered on the commercial side, growing the Harpin business, growing or launching our pre-tech, but there's more to do. We've got more products that we want to bring to the market, and that's how we get to our 30 million growth. So in summary, we're in the sustainability ag sector. It's growing at around 16% a year. I love this sector. I think it's a great place to be. It's rapidly growing. It's what consumers, it's what growers are looking for, and the technology is really fitting the needs, and we have products that really fit in these large markets. We've invested $25 million for vaccines and plants, and we have major launches planned over the coming years. We're targeting 30 million of sales in 2025, and we feel like we're on a great trajectory to deliver that. And we want to deliver cash positive within our existing reserves. So there's no plans for an additional fundraise. We feel like we've got the right cash to deliver without going out and doing a fundraise. And we do explore opportunities for consolidation in this sector. We believe that consolidation will happen, and we want to be poised to be in a position to play in that. So if you look at our aspirations, our plans are to deliver just over 10 million in 2022. We feel very well poised to deliver that with growth to 30 million by 2025. So in summary, why invest? First of all, we've had a great first half, and that's building on a strong 2021. We have sustainable products that are very effective. We have unrivaled market access. As I mentioned earlier, we have exclusive relationships with these large distributors, and you can see the results of that through the growth that we achieved. We've delivered on low cost. Low cost goods is very important for us. We cannot bring a product to market unless it's achieved certain cost of goods. That's quite a bit different than some of our competitors, and we feel like it's the right strategy for us. We've had a strong initial launch of Sawari in Brazil, and we want to build on that with major launches every year. We had a strong performance in the first half, growth of 60%, and our Harpin business grew 37%. As Jeff mentioned, we continue to be tough on working capital. We want to continue improving that, make sure that we've got a strong balance sheet, And we're very positive about prospects for 2022. And we will reach cash positive within our existing reserves. As I mentioned, there are no plans for an additional fundraise. And with that, Paul, we'll turn it back to you.
Fantastic. Thank you very much indeed, Jeff, and thank you for everyone and the presentation today. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the top right-hand corner of your screen. Just while the team take a few moments to review those questions submitted today, and I'd like to remind you that recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. We did have a number of pre-submitted questions from investors, and perhaps we could start with these, if I may. The first one reads as follows. Can you repeat the assurance given the RNS of the 12th of May that we're confident that Plant Healthcare will reach profit within these cash reserves, and indicate whether or not that profitability will be enabled through the planned growth without recourse to more capital?
Yes, the short answer to that is yes. We will achieve profit within our existing reserves. We have no plans for a capital raise. And I think given the strong performance coming off 21 and our first half of 2022, we feel very good about our position. We did have an increased cash burn in the first half, but I think Jeff went through that. It was planned, and the investments that we've made, and not only Harpin but pre-tech launches, are now delivering on that, but we have no plans for fundraise.
That's great.
Yeah, I think just to build on that, Jeff, and everybody, from the board point of view, we are very, very clear that we're going to deliver our organic growth plan within our existing cash reserves. And I'd like to emphasize 2 points that Jeff Hovey made. First of all, our operating expenses were up in the first half 22 compared with first half 21, but they were flat in the first half of 22 compared with the second half of 21. Following the fundraise 14 months ago, we increased our investment in product launches. As we said we were planning to do, we did that from the middle of last year, and operating expenses are now flat. The other thing, if you look, we generally speaking burn more cash in the first half than in the second half, and we fully expect to repeat that pattern in 2022. Just to reinforce that point, the next question of the pre-submitted ones that I wanted to pick out that maybe Jeff Hovey could emphasize here is, the question is, the impressive 60% increase in sales of 2.1 million came at a decrease in cash resources. Can you please provide a rough breakdown of how much went to increases in debtors, increases in stock, paying down short-term debts, and operating expenses? Jeff, can you just emphasize the points you mentioned briefly during the presentation?
Okay, I'll reiterate. Certainly the stock was the biggest piece. Harpin stock, that was probably over 50% of the burn. Just a reminder, we didn't have that expense in the first half of 21. The pre-tech and sales and marketing increase expenses, that was another significant piece of the cash burn, possibly 25-30%. And then we also had some CapEx that was spent in the first half as we continue to invest in our Seattle lab associated with our pre-tech products.
Thanks, Jeff. Maybe I could pick out another question here. That Sean D, you say, hey, I can see your 2025 revenue targets, but I'm interested in your 22, 23, and 24 targets. If you could please provide those, that would be great. Thank you. And I'm going to take this initially and then pass to Jeff Tweedy to say a little more on that topic. But Sean, I would love to put them out there, but I'm not allowed to because they will be considered market forecasts. So we have a clear plan which does set out those targets, but we have to keep that under the hood, as you say in the States. There are analysts out there that follow us, particularly, of course, our Nomad Senkos, and they provide certain forecasts, and we are obliged to make announcements when our trajectory looks significantly different from those forecasts. So, Sean, I would love to say more, but but we can't put those numbers out there. But maybe, Jeff Tweedy, you could say something about your confidence and the way you see revenues building over that period, without being specific, of course.
Yeah. Again, yes, we're not allowed to do that, but we do have an aspiration of 30 million, and we feel very confident not only in the product launches that we have, but additional agreements that will bring in our market access that will help us reach that. And we feel like those are the two key drivers that will help us deliver on that 30 million, and we feel good about our progress towards that.
Thanks, Jeff. Roger F., and good to see some familiar names coming up here. We really appreciate the loyalty, and we really appreciate the questions that are coming up in these meetings. The question for you, Jeff Tweedy here. Roger says in the first half of 2021, you were very upbeat on half-in sales in corn in the U.S., but you didn't mention it this time around. What conclusions can we draw from that?
Yeah, I mean, I think our sales have been very good. Corn acres are down, and the market is behind because of the late season. So I think through the first half, we haven't seen the full results of that. We feel very confident about our U.S. corn business, and we continue to work with our partner in the U.S. on not only our current product offering, but bringing new products to market, additional offerings to help us expand there. So we feel very good about that market. It's a very important market for us, and it will continue to grow.
I'd like to pick out another question from Roger again here. Another one for you, Jeff Tweedy. Why are you using half-in Argentine soya rather than pre-tech? Is that because the diseases are different, and do you anticipate using PHC 279 in Argentina?
Yeah, it's a very good question. I think the simple answer is that the registration timelines in Argentina are quite long, and we had started the process with Harpin several years ago. I think it's taken us slightly over 3.5 years. Part of that was due to COVID and a delay, and so we chose to go with Harpin first because we were developing PHC 279 in Brazil. There's not as much disease in Argentina as you would get in Brazil, so I think the product fits quite different. But there are other countries, Paraguay would be one, for example. We have strong interest in taking the soy product and expanding it because they do have significant disease, Asian rust in Paraguay, and that would be a market that we have a high level of interest in entering as well.
Thanks, Jeff. I'm going to take a couple of the more stock market related questions now. One of the pre-submitted questions said that we saw Osprey reducing their holding some months ago, and now Lombard Odier. This is clearly not a good signal to the market. Do you have a view on why they may have sold? And what assurance can you give investors that these significant shareholders are not seeing something we're missing? Thanks for that. So I'll take that one. First of all, clearly investors make their own decisions for a bunch of different reasons, and they're clearly not all related to us, and they clearly don't consult us or even necessarily tell us. That being the case, we are very close to Osprey, where we have a strong dialogue with Osprey, and they did call me and they said, look, we're going to make this sale, and in reaching this decision, we balanced two different things. We balanced, first of all, is Osprey sending a negative signal to the market, which is the point that the question makes, and secondly, however, that it would be positive for Plant Healthcare to have a more balanced shareholder register. So they decided in the end to sell a chunk. I would like to say it was well north of the current share price. And I'm delighted to say that around that time there was an increase in the shareholding of Janus Henderson. And so we are very comfortable that having a somewhat lower concentration in the hands of Osprey and a more balanced shareholder register is very positive for our share price in the medium term. And indeed, we have, over the last 2 years, seen the development towards a much more balanced shareholder register, and that has significantly improved liquidity in the stock, which I think will stand us in good stead over the future. Lombard Odier, their position in plant healthcare is now very small within a large fund. It's a tough market. Investment fund managers do occasionally seek liquidity by selling part of particular positions. I don't have any great insight into their thinking, but nor do I understand that they have any particular negative view of plant healthcare. So I hope that answers that question. We are extremely appreciative of the support we get from our shareholders, including the very large ones. There's another shareholder one which I'm going to pass to Jeff Harvey here. In fact, there were two related questions here. One of them is PHC listed in the US, and if not, are you considering such a move? And then Roger F. says, is there much trading of the shares on the US OTC market, given this listing was made almost a year ago? Mr. Harvey, this is a favorite topic of yours. Do you want to take this one?
Yes, we are trading on OTCQB for about a year now. The volume, I will admit, has been frustratingly low. We've had a couple different options to try to increase that. The issue we have is a lot of the U.S. investors are struggling to invest in the U.S. market. In the UK market. So we've come up with, I think, with a different plan that we've discussed probably just only about a week ago to kind of help U.S. investors invest more easily into the UK market. But that's been the struggle.
Thanks, Jeff. I'm going to go back to some of the more operational questions here. Jeff Tweedy, one of the pre-submitted questions, hello, what progress has been made on sourcing alternative manufacturing capability for Harpin and Proact outside China, just in case of future sanctions, and what impact might that have on your cost of goods going forward?
Yep, thanks, Chris. We made an announcement on June, I think it was around June 20th, about sourcing a new source in Europe for Harpin Alpha Beta. So we have a new long-term agreement with that manufacturing, not only for SORI, but also for Harpin Alpha Beta. That will start to come into effect in early 2023. Some countries it will take probably mid-year of 23 before we get all the registrations. But our plan is to move the manufacturing to Europe and combine it with our SORI business today. So we will be moving it outside of China.
Great, thank you. There's a couple of questions from Richard S. about inventory. Is your inventory warehouse centrally or by distributors as consignment stock? And what is the lead time for purchasing inventory, level of volume discounts available? How robust are your protections over the products? Mr. Harvey, do you want to start with that, or maybe throw the second part of it to Jeff Tweedy? Okay.
Yep, our inventory is indeed warehoused centrally throughout the world. Some of it is in, most of it is in the U.S. Some of it is in Spain as well as Brazil. We do not, I emphasize, do not consign inventory. We haven't done that since I've been here. I'm not a proponent of that. We do not do that whatsoever.
Nor will we.
Nor will we.
That's a no-no. We will never consign inventory.
Okay. Sorry, there were a couple of other elements to that question in terms of the level of purchasing, discount volumes. Do you want to pick that up?
I'm just looking at it, Chris. So lead times, purchasing inventory. Yeah, we typically, our purchases from manufacturing, we look on a 3-year kind of outlook, if you will, and we do kind of a base upside downside. And then our typical lead times around purchasing are anywhere from 6 months out with our new agreement that we have in place. And the volume, the question around volume discounts, I assume that's a customer question. We typically do not do that. We have agreements in place with customers pretty much on a set price, so there's no volume discounts that are given. What I will say is with our new manufacturer, there are incentives if their manufacturing is at higher levels, then that helps us on achieving some lower cost of goods, which will help on our gross margin. So we do have incentives with our manufacturer to manufacture the product at higher volumes, which helps us reduce costs.
Thanks, Jeff. There's a couple more market questions coming in. Andrew C. wants to go back to the topic of U.S. corn. By the way, Andrew, thank you for your nice comments about congratulations on really good revenue growth. That's appreciated. But going back to U.S. corn, what about the outlook for corn in the future, Jeff?
Yeah, I think, the corn market this year, the acres were down for two reasons. Number one, soybean and wheat were extremely high at the time of planting, so I think there was more wheat and soybeans planted, and the delay in the season. I think that drove corn acres much lower than what were originally projected. I fully expect that will return, and I think what you're going to see is the drought that's going on in the Midwest right now really impacting yields. So I think the carry out will be significantly lower when they come in with their yield forecast. I think you're going to see a much smaller crop, which should drive higher, more acres planted in 2023. So I think it looks strong for corn. Our partner is well positioned, and as I mentioned earlier, we're looking at some additional products that we're going to bring into the market with that supplier. So I feel very good about that market. Even though the acres are down, I expect them to fully come back in 23.
Thanks, Jeff. And another one, absolutely for you here from George T. Concentration of effort right now seems to be in the Americas. What are your plans to Europe, Asia, and Africa?
Yeah, it is concentrated there today, but I would point to what we were 2 years ago. 2 years ago, 50% of our business was in Mexico. So if you look at where the distribution will be this year, we've really expanded in the U.S., really expanded in Brazil, and our European business has been growing at 15% a year. We hope that we're going to get some additional registrations in Europe, which will help us expand Harpin into markets that we're not in today. As I mentioned, pre-tech with our partner Agri, if that looks positive, we would expand into the UK market in 2023. And we are looking at markets in Asia, China, India, Japan are markets that we are actively looking at today. I think our distribution model will be a little bit different there because it's highly fragmented. So we want to make sure that investments that we make will not significantly add OpEx to our business. So we are looking at different types of partnerships there, but we do have aspirations to expand those markets. The other one that I would add to that's not on the list is Central America. I think Central America is a very significant market for biologicals, and we're actively looking at potential partnerships in Central America as well.
Thanks, Jeff. And related to that, I guess, having one more go at the operating expenses question, Sean D says, I can see increasing OpEx that appears to be due to product development and launch. Is that now expected to reduce, or will the company's ambition to launch one new product per year see this relatively high level of OpEx maintained or even potentially increase?
That would be me. Yep. That's a great question. Yep, definitely OpEx was up over last year. We certainly did not expect it to increase. Either looking at from the pre-tech point of view, we certainly will not increase it. We'll either keep it steady or decrease it a little bit. We have a good team, not only in Seattle, but here in Raleigh. We have good plans going out for 2 years to make sure we maintain costs, make sure we spend the money appropriately, and get the best return out of the investment that we make.
Yeah, and I would just add that our OpEx, well, it has increased year over year in half one, as mentioned earlier. If you look at our first half this year versus second half of last year, it's pretty much flat. Those were planned investments, not only in registrations, but also in people. But as those registrations, we submit those, we expect those things to start to wind down. So we did not see significant increases in OpEx over the next couple of years.
Thanks both for that. I recognize time is going on, but I'm going to pick out one more question here from Sean D here, which I think both of you should have a go at this one, which is a really good question. What are the biggest risks facing the company over the next 12 to 24 months? What do you see as I would guess you could talk a little bit about opportunities as well as risks, but particularly what are the things that worry you at night, guys?
Yeah, I mean, we get this question a lot. You know, I feel very good about where we are with customers. We want to continue to expand that. We feel good about the products that we have now and the registrations coming. I think the things around risks that are kind of out of our hands are two things: timing of registrations. So making sure that we deliver when you submit, they come out on time. We've seen some delays in those registration timing, somewhat due to COVID, and at least that's been the feedback that we've gotten from the regulatory authorities. I think second of all is you're going to have a weather or a drought event. Spain is a good example this year. We've had a weather event there, and so those are things that we can't control. But what we do need to make sure that we do is continue to grow our market and get into these different markets to reduce those risks. You're going to have a weather event. Just, it's part of ag. So what can we do to really manage that and make sure that we have growth in other areas when those events do happen? Jeff?
Yeah, I would certainly agree with that. I mean, what keeps me up at night right now, even though we've kind of mitigated the risk, which I mentioned in my presentation about inventory, we have certainly enough for the foreseeable future. But with the global supply chain issues still happening, I mean, it's a concern for me. I mean, certainly not right now, but that would be something that keeps me up at night in the future, certainly.
Great, thank you very much. So I think that's all the questions. I'm going to thank you very much, everybody, and for all those great questions. I'm going to pass back to Paul.
Fantastic, Chris. Thank you, Jeff. And Jeff, thanks indeed for covering off all those questions we've had through. And of course, any further questions that do come through, the company will be able to review those and we'll publish responses where appropriate for the company. Jeff, perhaps before redirecting investors to provide you with their feedback, which I know is particularly important to you, could I just ask you for a few closing comments, please?
Yeah, sure, Paul. I mean, I would say a couple of things. We've had a fantastic first half and really building on a strong 2021. We're off to a great start. We feel very good about our position, not only in our current existing Harpin business, but where we're at a pre-tech, what it's delivering in a relationship with distributors. And we're fully confident that we will deliver on our targets for the full year. But we're off to a good start. Very excited about it. Good space to be in. And looking forward to the second half and then coming back and having a similar conversation with investors at the beginning of the year.
Fantastic, Jeff. We look forward to that. Thank you again all for updating investors today. Could I please ask investors not to close this session, as you'll be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of Plant Healthcare PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good afternoon to you all.